As we get into 2023, there's a lot of uncertainty of 2022 that we seem to be carrying forward into the new year. The Russia-Ukraine conflict is still on. The rising China COVID cases is impacting the global commodity demand. The aggressive rate hikes from central banks and the US dollar moves have all impacted the asset classes. But what are the signs that you need to watch as you make your portfolio allocations in the new year is what we will discuss with our top names in the industry today. Hello and welcome to Commodity Champions, and we will discuss about commodities on how you need to trade them in 2023. I'm Manisha Gupta, and joining me on the show is Hansen. He's head of commodity strategy at Saxo Bank. Hi, always a pleasure to have you on CNBC-TV18 India. I want to start with what we really have seen in 2022 in sense of commodities, where we saw all-time highs, multi-year highs, and then the prices declining 40 to 50% from those kind of levels, and then the 8 to 10% of a gain from those lows as well. It has been a volatile year. Is that one of the things that we are carrying forward into 2023?
Good afternoon, Manisha. Yes, absolutely. We have multiple uncertainties as we start 23, and that will drive some continued volatility. But 22 has most certainly been a year where commodities has made you can call it a comeback in terms of how it's being perceived by consumers and people around the world, because it's suddenly become a year where we've become accustomed to the fact that we have tight supplies in several key commodities, and that creates this volatility spikes that we're seeing. So more of that to come in the start of the new year, and obviously in the short term, as you mentioned, the focus will still be on the war in Ukraine, but probably more importantly, what's the short-term developments in China.
Sometime in 2020 and 21, there was a conversation about a bull cycle perhaps in commodities. How do you see as we end this year?
I think the bull cycle is still very much in play. We have seen a correction during the past few months here, and I think primarily the correction has been driven by the developments in China, where we simply have the recovery from the COVID lockdowns has been delayed by many months, and now we are still looking probably for another 1 to 3 months delay as well. The dollar was a major development as well this year, and probably most importantly the rapid rise in interest rates that we've seen across the world, also having in the latter part a somewhat negative impact, given the prospect for it driving some economies potentially into a recession next year. But I think the supply outlook, and that's where we could see an interesting year next year, that the supply outlook remains tight for many commodities, and that basically means even if we should have an economic slowdown, then the supply situation will equally also be important, and that could drive some of these key commodities to higher levels.
And what are these key commodities that you see? Is it food, or do you think the industrial commodities could see some support as well?
I certainly don't hope that it's going to be the food side of the equation. That obviously depends very much on the weather. We do know that we're entering 23 with the lower stock levels than we entered 22. That obviously leaves us more exposed with regards to any adverse weather developments next year. But I think where our main focus is probably primarily on the metal space, both industrial and precious metals. We are seeing a recovery eventually in China. There's no doubt they need to get the growth back on track, and that will be commodity intensive, but more selective than we've seen in the past. They're not just going to go out and build new cities that no one wants to live in. So it's potentially not steel and concrete that we're going to look at. It's more the industrial metals we're used towards the infrastructure and the energy transition that will be in play. And on the precious metals, we've had a phenomenal year, I would say, in gold and silver. Gold especially, it's unchanged in the year in dollar. In a year where we've seen a rapid rise in the dollar, we've seen the biggest jump in bond yields in decades. And despite of these developments, gold is almost finished in the year, close to unchanged, perhaps even with a small plus. And what happens in next year when we start to see the dollar reverse some of its strengths? We see eventually that interest rate stops rising, and more importantly, that inflation does not come down to the level that the market is currently pricing in. These are basically our reasons for maintaining a bullish outlook for gold, and with that also silver next year.
We'll have to talk to you about the Saxo Bank report about $3,000 per ounce in case of gold. How have you seen that report? What's your own sense?
Well, it's part of our annual exercise of trying to come up with 10 outrageous predictions. Basically, the developments that we don't see happen, but at the same time, if they do happen, it obviously has a major impact on markets and the way we look at markets. And the $3,000 call for gold is not because we're actually seeing gold down. We are bullish on gold next year, but obviously for $3,000 to be reached, a lot of things has to be aligned at the same time. But it is building on the assumption that central banks will eventually lose control with their inflation fighting ability, simply because the economic outlook slows to the extent that they'll have to reverse some of their focus there. And just simply some of the inflation that's coming into the system is structural. It's like getting a genie out of the bottle. Once it's out of the bottle, it's very difficult to put it back in again. And that basically means that inflation will not come down to 2.5% anytime soon. And when we start to get that realignment, we could also see a realignment in prices for some of the metals, especially gold. So yeah, it's an outrageous call. Some have said, well, it's not that outrageous, but I think just looking at the price it has to travel to reach that level, it is quite a significant jump, which we don't have as our base case. But still, I wouldn't be surprised if we could see a record high next year.
Let me push you for some of these price outlooks as well. So outrageous, yes, that done with. What's your sense on what are we looking at as in sense of range for gold and silver for the new year?
Well, we're trading just above 1,800 this morning. It's doing quite well, considering the news from Bank of Japan overnight, which has sent the bond yields higher and the dollar lower. So it does indicate that right now the main focus in the market is the dollar. So that obviously will be the key driver next year. But I see gold move, as I said, back towards 2,000 in the near term, with silver potentially getting some additional tailwind from industrial metals, keeping a close eye on copper in that regard. Copper potentially could even do better than that. So that could potentially take it up towards the 30 level.
Okay, and since you are looking at copper as another gainer in the next year, what's your sense on prices there?
Well, the market has been lukewarm on copper in 23, just simply from the fact that we know there will be additional mining supply come on stream next year. Some of those has actually already started to be lowered, or projections started to be lowered. And then right now we're looking at a situation in Panama where the government is forcing the mining company in charge to either pay higher taxes or leave the site. That is basically 1.5% of global mine supply. That is supply we most certainly can't live without next year. So with the transformation, looking at what's happening in Europe and in Asia, with the transformation is gathering pace, and it will require a lot of copper. So we remain positive on the outlook for copper and could see a record high, not in 24, but perhaps already next year.
All right, a record high in case of copper prices as well. And what's your sense on energy? Because we've seen this week also come out in sense of European Union agreeing for a gas price cap as well in the month of Feb. How will all this pan out, and any price views that you would have for energy?
Well, gas price in Europe has returned to the €100 mark. We were just briefly above 130 as the cold spell set in. I'm wearing a jumper because it is cold in Scandinavia. We're keeping the temperatures low in order to preserve energy. But so far, the crisis, the gas price this winter is over. We're not going to have a crisis. The inventory levels are so high that we have more than a month worth of peak demand just in stores relative to what we had at this time last year. But the worries are obviously still for the coming winter, the next winter. But I think as well, if we do get a solution to the situation in Ukraine, which obviously is a very big if at this point in time, if we do get a solution, we will also see increased flows of gas coming back to Europe. Not at the degree that we saw in the past, but obviously they will probably send more gas. So I'm quietly confident that we will see the situation continue to stabilize. If you look at the energy markets for fossil fuels in general, crude oil prices probably has found a bottom, I think, at this point. SPR refilling in the US, OPEC Plus keeping a close eye on prices and potentially stand ready to cut production if needed. I think it has created a soft floor under the market. Are we going to see a return to above 100? I doubt that in the short to medium term. Once we get through the lockdowns or the virus outbreaks in China, I think we could see a return to the $90 to $100 area. And that's probably where I'd like to see it trade most of the time next year. But obviously, again, forecasting oil prices is extremely difficult. Just looking at what kind of moves we had so far this year.
Well, I understand that is going to be, as we've seen in 2022, the price bets came in earlier than expected or didn't come at all. And that kind of uncertainty is what we are getting into 2023 as well. But thank you so much, Ol, for joining us and giving us a sense on all of those commodities and what to expect in the new year 2023. Welcome back. We're watching Commodity Champions. I'm Anisha Gupta. And what will 2023 look like for the commodity space? What are the key events to look at while planning your portfolio? To answer all of these questions, I am now joined by Edward Morse, Managing Director and Head of Commodities Research at Citi. Ed, hi, such a pleasure to have you. I want to start asking you about the price view that you would have on the energy space. So whether it's about crude oil or natural gas, what's your sense on these?
Well, we think that they're going to remain volatile, maybe not quite as volatile as last year, but still volatile on a short-term basis. And that is a result of several factors. The first one, I would say, is a significant lack of liquidity in futures and options markets, which means that we see sell-offs, we see buying that's very erratic, and we can have one or two firms enter the market in a big way if they have a big position for themselves and there's not enough liquidity to absorb whether they're selling or whether they're buying. And we then see prices going down by $5 or more or up $5 or more. We don't see that changing anytime soon. The second factor involved in the volatility is, of course, the really significant lack of inventories in the world, so that when we have seasonal changes and we have changes that are impacted especially by weather, we have a greater volatility because of a lack of cushions that are in the market. And a third factor is the weather itself, and that's because ever since the late 1990s, ever since the late 2019-2020 period, we've seen the global gas market become a global market. It used to be a fragmented market. It was fragmented in part because underlying gas is an inability or an expense of transporting it from one place to another. Even more restrictive were destination restrictions that were imposed in most of the first 3 decades of LNG. And that's because these projects are so expensive in terms of both liquefaction capital required and regasification capital required. And then enter the United States, which by the end of the last decade became the largest LNG exporting country in the world. And the US has rules against destination restrictions, which has allowed natural gas to move from one place to another on a spot basis whenever there is a shortage one place or another. So we will have undoubtedly weather affecting the natural gas markets far more than affecting other markets, and they'll be rippling around the world. If we have a polar vortex in Europe, for example, we can see current prices, which are in terms of dollars per million BTUs, around 6 or 5 in the United States, and around 23 or so and 25 in Europe, and a little over 30 in the Asian markets at the moment. The European market is getting tighter with colder weather. If we have a polar vortex, we could see on a BTU basis gas going up to $60 per million BTUs or even higher, 10 times where they were at the beginning of 2021, 3 times or so higher than now. And we think there'll be much more volatility in the gas markets.
Oh, clearly, crude and gas both continue to be quite volatile, but we understand those ranges that you've told us. I also want to talk to you about the gold prices, which in the last quarter of the year have seen a bit of a rebound. Would you advise allocating funds for this in the new year? And what's your sense on prices?
We actually think that when we get to an easing of central bank tightening, then gold will see its day. The increase we saw when gold reverted back above $1,800 an ounce not so long ago, that coincided with a fall in the value of the US dollar. DXY went from about 110 to an index of around 102. And then the Federal Reserve Bank, despite the skeptics who said they were going to slow down rate increases, did not do that. And we don't think they're going to slow down until they get to a higher level. So we think gold will be bouncy until the central bank, and particularly the US central bank, slows down and stops its rate increases, at which point we think gold will be on a rebound, and we think that gold will likely exceed the $1,900 an ounce level by the end of the year, and higher than that in 2024.
Okay. So gold prices can stay around $1,800 per ounce, but what about silver? Because this has seen a big range as well. Do you see industrial demand support prices in the new year?
Well, silver is kind of funny. It's neither a pure industrial metal nor a pure precious metal substitute for gold. So it responds both to the way gold is responding, and it responds to industrial production. We don't see any massive increase in industrial production in Europe. We see a continued slowdown of it in the US. The two stars of the world in terms of growth of industrial demand in the year might be in Asia, might be China and India, but in China, the rebound is not going to be in the first quarter. There are too many headwinds, including the continued evidence of COVID itself ramping up, even as the lockdowns are easing. So to the degree there would be an industrial rebound, it's likely to be the latter part of the year rather than before then, and more likely to be, as I said, in East and South Asia than in either Europe or North America.
All right, at least there is some hope in the second half of next year. Also, steel and iron ore prices have seen support on China's stimulus injections. Your sense on all of these commodities in 2023?
Well, sense on commodities in 2023 is going to be very divergent from one another. We think that unlike some others, that we're not entering a commodity super cycle. We think unlike others, the evidence is overwhelming that the cost structure of the industry for oil and gas is such that even at these prices, there's an encouragement of a new investment. We think the new investment is adequate. You mentioned iron ore, where we've raised our prices recently. That has to do in particular with the status of inventories around the world. China's starting to ramp up a little bit on its industrial production. So we've raised our price outlook for iron ore, getting above $140 a ton in the interim, maybe going even higher. But given the cost of extracting iron ore, we expect that by the end of the year, iron ore prices will level off and get back down to the $100 range. When we look at industrial metals, we are actually on the short side for the short term and on the long side for the long term. We've seen adequate inventories in China with their own slowdown. We've seen lack of demand in the short run. We've seen financial flows into the market that have recently raised the price of not of all, but most metals. We think they raised the price to a level that's not not really realistic in terms of the supply-demand balances today. On the other hand, while we expect prices to come down from their highs in the first quarter, we do think that by the end of the year, we think most industrial metals, with perhaps the exception of aluminum, will be on the rebound. And indeed, we are very positive on most industrial metals, particularly the metals that have an important role to play in battery power. And that includes copper and aluminum eventually for purposes of wiring in a world in which electric vehicles and electrification in general and the distribution of electricity are becoming more important. But we have nickel and we have cobalt and manganese and other battery metals, including lithium. Lithium may be the one exception where the demand is hitting the marginal price at the end of the supply curve, and the prices will go up. And we've really seen an inadequate amount of investment on the metal side. I say the big exception is lithium, where prices have gone up a significant amount over the last year. But the cost of extracting lithium is a tiny fraction of the price in the marketplace, maybe 1/10 of it at the moment on average. And that suggests that as more lithium is brought into the market, the price will have much more downward pressure, unique among the battery metals.
Fair point. But Ed, among the base material prices, the best bullish bet clearly continues to come in case of copper. What kind of demand-supply scenario do you envision here?
Well, we envisage a supply and demand scenario where the price of copper at the margin will grow above $9,000 and hit $10,000 a ton before long. So it's really looking at where we think demand is coming from and what a supply curve is telling us.
All right. That's a lot of non-agro commodities, but I do want to talk about the soft commodities. And this was a year of highs and immense profits. What's your best bet, or what catches your eye for 2023 within softs?
Well, it depends on what we're looking at. What catches our eye initially is that when we look at the grains complex, that the world was caught in a tight market when the Russia-Ukraine conflict started. And then there were concerns about everything from fertilizer and where it's going to come from to what if there is a disruption of grain exports, corn and wheat from Ukraine, and that falling into a shortage in Russia, and what the impacts for that going to be on emerging market countries dependent upon those Russian and Ukrainian exports. And then we had bad weather in Brazil, bad weather in the United States. But as you know, and we had one other thing, we had countries, including India, that put a ban on the exports of softs in particular in order to preserve a lower price in a domestic market. But a lot of that is easing, particularly on the grain side. A little bit more complicated when it comes to the other softs, when it comes to sugar and coffee and cocoa and the like. But still we see, as a result of higher prices, more acreage under cultivation seasonally in both Latin America and Australia and other parts of the Southern Hemisphere, and then followed by more acreage under cultivation in the Northern Hemisphere. Undoubtedly, we don't know the level of drought in the future. Brazil has come out of its drought. The mid-continent of the U.S. has come out of its drought, and Europe has come out of its drought. So the weather looks more favorable, and we think the prospects are, for most softs, neutral to bearish.
All right, that's good news, at least from the food inflation part of it, that most soft commodities could be looking at neutral to bearish cues coming in for 2023. Ed Morse, always a pleasure talking to you. Thank you so much for joining us with your sense on all of those commodities. And with that, it's a wrap on this edition of Commodity Champions. Thank you for watching.